Today's market move looks calm on the surface, but underneath it tells a much more interesting story. U.S. Treasury yields are pulling back, equities are trying to stabilize, and investors are once again recalibrating expectations around rates, growth, and risk. In this video, we'll break down what today's move in the 10-year yield really means, how the S&P 500 is reacting to it, and why Nasdaq remains more fragile despite the broader market holding up. Let's start with QQQ. Nasdaq was clearly the weakest index today, down more than 1.5% intraday. The move wasn't gradual, it was sharp and directional, especially late morning. That kind of price action usually signals forced de-risking rather than casual profit-taking. Growth stocks had been leading recently, positioning was stretched, and when momentum slows even slightly, tech tends to unwind faster than the broader market. What stands out is that this was not just a slow bleed, it was a momentum break. However, it's important to stay objective. We are not seeing panic levels yet. Volume increased, but not dramatically. There's no structural breakdown, just a clear intraday loss of control by buyers. For now, Nasdaq is reacting to positioning pressure, not systemic stress.
Now let's look at the S&P 500. SPY is trading mostly flat to slightly positive, showing resilience rather than strength. This behavior fits perfectly with what we're seeing in yields. When rates pull back modestly, the S&P often enters a consolidation phase instead of pushing aggressively higher. What stands out today is the lack of strong follow-through. Buyers are present, but they are selective. There's no broad-based risk-on behavior, just steady accumulation in large-cap names. This tells us the market is still in wait-and-see mode. Investors are comfortable holding exposure, but not confident enough to chase prices higher. In other words, SPY today reflects balance. Now the most important part, the 10-year Treasury yield. Today, yields dropped sharply, down over 1.6%. That's critical. Normally, falling yields support equities, but today stocks sold off anyway. This divergence suggests something important. The bond market is pricing in slower growth expectations or increased caution. When yields fall because of cooling inflation expectations, that's bullish. When yields fall because of growth concerns, that's defensive. Right now, this looks more defensive. Markets may be reacting to softer economic signals, shifting expectations around Fed policy timing, or simply repositioning ahead of upcoming macro data. The key takeaway: today's move was not caused by rising rates, it happened despite falling rates. That changes the interpretation completely. To sum it all up, the bond market is cooling, not signaling stress. The S&P 500 is stable, supported by large-cap strength, and the Nasdaq remains the most sensitive piece of the puzzle, reacting cautiously to every shift in rate expectations. This is a classic environment of consolidation, not a top, not a breakout, but a market digesting information. For now, the key variable to watch remains Treasury yields. As long as they continue to drift lower or stay contained, equities can hold their ground. But for a sustained rally, the market will need clearer confirmation on rates and growth.